Right now, Bitcoin is just hammering against this massive resistance ceiling at $76,000.
Yeah, a massive ceiling.
And, if you look at the social feeds, retail traders are just absolutely euphoric. I mean, they're looking at that green momentum and drooling over what they think is a straight uninterrupted shot to 169,000.
Right, the classic straight lineup.
Exactly.
Yeah.
But what if that euphoric price action isn't a breakout at all? Welcome to Bitcoin Deep Dives by MyCryptoParadise. Today, we're taking a magnifying glass to some really fascinating new analysis from Simon.
Yeah, one of the master traders over at the Paradise team.
Right. And our mission for this deep dive, well, it goes way beyond just plotting price targets on a chart for you. We're really unpacking the underlying behavioral science of the market.
Because, the research we're looking at highlights a pretty brutal reality. Surviving in crypto it has very little to do with short-term luck. And it has absolutely everything to do with mastering a professional trading mindset. The market is effectively this environment that's engineered to transfer wealth from the impatient straight to the patient.
Okay, let's unpack this, because this is the core paradox that Simon's notes set up for us.
Yeah.
While the masses are out there currently taking on massive leverage.
Leverage is insane right now.
It is.
Yeah.
They're treating that 76,000 level like a guaranteed winning lottery ticket. But the Paradise team is advocating for the exact opposite approach.
Completely the opposite, yeah.
They are actively endorsing boredom.
Oh.
Just, sitting in cash, playing defense, and waiting for very specific, highly uncomfortable capitulation events.
Right. And to understand why endorsing boredom is actually the most profitable stance you can take right now, we really have to look at the mechanics of what's happening at that 76,000 boundary.
Mm-hmm.
Because human behavioral biases, they're causing everyday traders to just see a bullish launch pad, But the structural data underneath is heavily, heavily signaling distribution.
Let's bring in the data points on that. If you go and look at the live fear and greed index from the MyCryptoParadise platform, the market is flashing high greed levels across multiple timeframes.
Yeah, definitely.
We're seeing scores consistently ranging between 60 and 80.
Yeah.
And on the 4-hour time frame, it recently spiked to hit that 80 mark.
Wow.
And the daily time frame is hovering right around 67. So the everyday trader sees that momentum, right? They feel the energy. And FOMO, that fear of missing out, it just completely takes over.
And that FOMO, it just overrides their analytical thinking. They completely stop trading the structural facts and they start creating the emotion.
Right, the emotion of not wanting to be left behind.
Exactly. Not wanting to be left on the sidelines when Bitcoin supposedly rockets to 169,000.
But I want to challenge the mechanics of this trap for a second. Because if 76K is just a mirage in the desert for thirsty retail traders, how does the trap actually function? If the market is flashing peak greed and millions of people are aggressively hitting the buy button, shouldn't that pure, unadulterated buying volume be enough to just smash right through the resistance? Why doesn't sheer momentum win here?
That's a great point, and that is where we have to peel back the curtain and look at the order book.
Okay.
Because when you look closely at the footprint the market left at that 76,000 mark, Simon highlights a very specific technical formation. It's a shooting star candlestick pattern. Right.
And just for anyone who doesn't stare at Japanese candlesticks all day long, a shooting star essentially looks like an inverted hammer. Mm-hmm. It has a very tiny body at the bottom and this massive long wick stretching upwards.
Yeah, and that long wick tells a structural story, really, of exhaustion and absorption. Mm-hmm. To understand why all that retail momentum didn't break through, you have to understand how smart money operates.
Whales.
Right, the massive whales and institutional players. They don't buy or sell using market orders the way a retail trader does on an app on their phone.
Right, they're not just swiping to sell.
No, they use massive passive limit orders. You have to think of these limit orders like a concrete dam built exactly at $76,000.
So they aren't like dumping their bags all at once to actively crash the price?
No, because that would cause massive slippage.
Oh, right, and that would hurt their own profits.
Exactly. They just set the wall and they wait. The smart money saw the retail FOMO building up. They knew everyday people were getting completely blinded by that greed index.
Mm-hmm.
So they intentionally used those euphoric retail buyers as exit liquidity.
Exit liquidity.
Yeah. As retail traders kept smashing the buy button, just throwing all their capital at the market, the whales just quietly absorbed all that buying energy. They just let their massive sell orders fill one by one by one.
So if 76K is a trap, then buying here is effectively just feeding the whales.
That's exactly what it is.
Retail pushes the price up, and the institutions gladly hand them their heavy bags. I mean, the buying volume from the retail side is completely neutralized by the sheer weight of the whales distributing their holdings.
Yep.
And that's why the price gets rejected and pushed back down, right? Leaving that long wick on the chart.
You nailed it. And the everyday trader gets caught holding an asset at a local top. Their capital is now locked up or actively bleeding out, and the smart money just walks away with the cash.
Man.
And this happens because retail is blind to the systemic reality of the order book. They're operating entirely on that behavioral bias of greed.
Which means the alternative is entirely psychological. If you don't want to be exit liquidity, you really have to shift your entire paradigm of how the market moves.
Absolutely.
And this brings us to, honestly, one of the most compelling concepts in Simon's research. It's this idea of viewing the market as a breathing organism.
I love that analogy. It's a phenomenal way to visualize market structure because the market isn't a straight line. It's an aggregation of human psychology. And like any living organism, it has a respiratory cycle.
Right.
It has inhales and exhales.
Let's define those mechanically for everyone.
Sure. So the inhales are the motive impulses. These are the powerful waves that give the market energy, driving the price forward and creating new structural highs.
The green candles everyone loves.
Exactly. But the exhales are the necessary corrections. These are the secondary waves where the market just rests, distributes, and consolidates all the energy it just spent.
And according to the Paradise team's structural analysis, Bitcoin is currently trapped in an extended exhale phase. We are in a larger degree bearish structure.
We are.
And to visualize this, think of an Olympic sprinter. An impulse wave is the 100-meter dash. The correction, the exhale, is the athlete taking a knee, gasping for air and recovering. If you try to force that sprinter to run another 100 meters while their muscles are just entirely deprived of oxygen, they're going to collapse.
They're going to completely faceplant. And yet, that is exactly what 96% of the crypto market is trying to do right now.
It's crazy.
They're thrashing around, exhausting their capital, trying to force profitable trades during a massive structural exhale.
But here is where it gets really interesting, because the way the remaining 4%, the true professionals, handle this exhaustion phase, that's the secret to long-term survival.
Right.
They don't try to force the sprint. They operate strictly on the 80-20 rule.
Yes, the 80-20 rule is the bedrock of professional capital management. It basically dictates that you spend 80% of your time simply defending your portfolio.
Just playing defense.
Playing defense. You are observing the breathing pattern, analyzing the data, and sitting patiently in cash. You only deploy capital and strike aggressively in the remaining 20% of cases. Those rare, highly specific moments when the mathematical probabilities are overwhelmingly stacked in your favor.
It really reminds me of how Warren Buffett operates in the traditional equity markets.
Oh, absolutely.
I mean, he is arguably the ultimate smart whale.
Yeah.
And right now, his conglomerate is sitting on historic, record-breaking piles of cash.
Unbelievable amounts of cash.
He's completely ignoring the daily noise. He isn't, panic buying into slight market momentum just because other people are getting rich on paper.
No, he's defending his capital. He understands that participating in a euphoric exhale is a fool's errand. He is perfectly content to sit on the sidelines, completely bored, waiting for a high-probability systemic event where he can deploy billions of dollars with maximum leverage and minimal risk.
And since Simon and the Paradise team are adopting that exact same stance, waiting patiently in cash, we really need to map out what that high-probability event actually looks like for Bitcoin.
Yeah, we do.
Because we aren't just waiting for a red daily candle or a slight dip in price.
Yeah.
We're waiting for a fundamental break in the market structure.
We are waiting for true, undeniable capitulation. And in Simon's structural roadmap, this is defined as Plan A.
Okay, let's talk about Plan A. It targets a very deep, very specific drop zone between $44,000 and $55,000. The research notes that historically, this represents the ultimate capitulation zone for the current macroeconomic cycle. I mean, it would be the psychological equivalent of Bitcoin's brutal drop to 3,000 back in the 2018 bear market.
Right, or the cascading liquidations we saw throughout 2022.
Yeah, exactly.
It represents the final violent clearing of the deck, the absolute bottom of the exhale.
But I want to push back on the mechanics of a drop to 44,000. because we always hear that capitulation is driven by retail panic. But retail traders have already been getting chopped to pieces in this sideways consolidation for months. Their capital is largely exhausted. So if we actually do drop all the way down to the mid-40s, wouldn't the true institutional giants-like entities like Michael Saylor's MicroStrategy or the massive publicly traded mining operations, wouldn't they have substantial safety nets?
You think so?
Surely they wouldn't just panic and dump their Bitcoin at the absolute bottom?
See, this is a crucial distinction to make, and it really gets to the heart of how market bottoms are actually formed. You have to separate the concept of emotional panic selling from mathematical forced selling.
Okay, let's break down that difference.
So retail traders engage in panic selling. They look at the red on their portfolio app, their behavioral biases trigger a flight response, and they hit the sell button out of pure fear.
Just pure emotion.
Right. Institutions, however, do not feel fear.
Right.
They operate on rigid ledgers, margin thresholds, and quarterly balance sheets. When the market enters that 44,000 to 55,000 zone, the dynamic completely shifts away from retail fear and moves into cold, hard corporate mathematics.
So take Michael Saylor's treasury, for example. He holds massive amounts of Bitcoin. At 44,000, he is holding a staggering unrealized loss based on his average acquisition price.
Right. And right now, an unrealized loss is just numbers on a screen. But corporations have real-world, localized debt. They have payroll, they have facility costs, and crucially, they have massive debt obligations and interest payments that must be settled in fiat currency, regardless of what Bitcoin's price is doing.
So if the fiat reserves dry up, they can't just ignore the bills.
Exactly.
But what about the Bitcoin miners? Because their mechanics are even more directly tied to the price of the asset.
Oh, the miners face an incredibly brutal mathematical reality. At those low price levels, the actual cost of the electricity required to mine a single Bitcoin exceeds the market value of the Bitcoin they are generating.
Wow.
The machine is actively losing money every second it runs.
But if the mining rig costs more to run than it generates, they don't just turn it off, right? Because they still have the loans they took out to buy the hardware in the first place. They have corporate debt that doesn't just disappear because the network difficulty adjusts.
And that, right there, is the trigger for forced selling. The miners are backed into a corner. To service their debt and avoid immediate bankruptcy, they are forced to liquidate their Bitcoin treasuries on the open market.
So they literally have no choice.
None. They aren't selling because they think Bitcoin is going to zero. They are selling because they literally have to, just to keep the lights on.
Which creates a massive localized supply shock.
A cascade of localized supply shocks, yeah. This forced liquidation creates immense, relentless downward pressure on the price. But more importantly, it facilitates the ultimate transfer of wealth.
Because who is buying all that Bitcoin being dumped by the struggling miners and the over-leveraged corporations?
The 4%, the cash-rich whales, the professionals who have been sitting in cash, executing the 80-20 rule, waiting for exactly this moment.
They just step in and scoop it up.
They step in and absorb those forced sales at rock-bottom prices. That specific exchange from weak, mathematically forced hands to strong, patient hands, that is the mechanical foundation of a true, durable market bottom. It's a fundamental transfer of control.
Man, that reframes the entire concept of a market crash. It's not a failure of the asset. It is a necessary mechanical clearing of over-leveraged debt.
Exactly.
But understanding the logical necessity of capitulation brings us to really the hardest part of this entire deep dive, and that's the psychological discipline required to actually execute this strategy.
Oh, it's incredibly tough.
Because sitting in cash while the market teases a $76,000 breakout, I mean, it goes against every human instinct.
It is the ultimate test of a trader's emotional regulation.
Yeah. Simon emphasizes a point in his notes that completely shatters the marketing illusions of the crypto space. He points out that the idea of turning $1,000 into $100,000 in a single week is pure fantasy.
Pure fantasy.
It's an anomaly disguised as a strategy. True. Professional trading requires a minimum of a full 3-year cycle just to properly backtest a strategy against all the different microcycles, bull traps, and capitulation events.
Because you need that 3-year horizon to see if your risk management actually holds up when the market stops going up in a straight line.
Right. And Simon has this brilliant analogy to frame the choice every listener has to make with their capital. He says, if you want excitement, go bungee jumping.
Yeah.
If you want thrills, grab a drink with your friends and go to a casino.
Yeah.
The flashing lights and the dopamine hits are great for entertainment. But treating your Bitcoin portfolio like a slot machine is exactly why everyday people get completely wiped out in 14 days, even after they had 2 years of sheer luck.
The casino mindset feels incredible during an impulse wave, sure, but it is a mathematical guarantee of ruin during an exhale. If we connect this back to the broader philosophy of the Paradise team, it requires fundamentally redefining what success in crypto actually looks like.
It's about shifting from the thrilling casino to the boring business.
Exactly. The professional mindset strips away the dopamine entirely. You look at the charts, you identify the exhale, and you actively endorse boredom.
Endorse boredom.
Boredom is a symptom of a perfectly functioning risk management system. You aren't chasing the euphoric highs, and you aren't sweating during the capitulation lows. You are operating a rigid probability matrix.
And a core part of that professional matrix is acknowledging that the market can always invalidate your thesis, right?
Oh, absolutely.
While Plan A is waiting for that deep capitulation flush down at 44,000, Simon's research also maps out the mechanics of Plan B. Because a professional is never caught off guard if the market decides to run.
Right. Plan B is the contingency for a genuine structural shift. But notice the discipline involved here. Plan B doesn't mean buying if the price temporarily pokes above 76,000. It involves waiting for Bitcoin to fully clear the massive macro resistance level at 82,000.
But even then, if we cross 82K, a professional doesn't just blindly market buy the breakout, right? Because that could just be a larger trap.
Correct. They wait for the structural confirmation. Once 82,000 is cleared, they wait for the market to exhale again. They want a confirmed secondary wave that comes down and successfully tests that 82,000 level, proving it has flipped from a ceiling into a concrete floor.
It's
only when that new support is verified by actual institutional buying volume do they switch their system to bullish tactics.
So they sacrifice the first 10% of the move to guarantee the safety of the next 90%.
Precisely. They would rather completely miss a trade or buy in slightly higher with absolute structural confirmation than risk their capital unnecessarily.
That really is the defining characteristic of a master trader. The focus is never on how much money can be made in the next 24 hours.
Never.
The focus is entirely on how much capital can be protected.
And that philosophy is really the underlying current of everything MyCryptoParadise is trying to impart here. The goal isn't to help you gamble your way to a quick, stressful profit.
Right.
The goal of this research is to fiercely, unapologetically protect your capital. Because capital preservation is the absolute only way you survive the exhales long enough to actually participate in and profit from the ultimate macro bull run.
Yeah. If you lose all your chips playing the slot machines today, you won't have a seat at the table when the real wealth transfer happens.
Exactly. When you make that mental switch from chasing profits to fiercely defending your baseline, you instantly elevate yourself above the 96% of the market that is just wildly swinging at every green candle.
Wow. We have covered a massive amount of structural and psychological ground today. We completely dismantled that $76,000 retail mirage, exposing the mechanics of the limit order sell walls and how smart money uses FOMO as exit liquidity. We explored the respiratory system of the market, understanding why forcing a sprint during a bearish exhale is just financial suicide.
Yeah, it really is.
We dove deep into the localized supply shocks and corporate math that drive true institutional capitulation down at 44,000. And most importantly, we made the conscious choice to abandon the disastrous casino mindset in favor of the boring, highly calculated business of professional capital defense.
Because survival in this space demands nothing less than absolute discipline and infinite patience.
And the incredible advantage you have is that you don't have to navigate these structural traps in the dark. The insights from the Paradise team are designed to keep you grounded, monitoring the breathing organism of the market so you can protect the capital you've worked so hard to build.
Right.
The goal is to guide you safely through the boredom and alert you when that rare 20% window of high probability finally cracks open.
And as we wrap up this analysis, I want to leave you with one final lingering question to ponder as you look at your own portfolio. We spent a lot of time today talking about the immense discipline it takes to sit on your hands and wait for a mathematical advantage. But ask yourself this: what if the absolute biggest threat to your financial future isn't a sudden market crash or hidden institutional manipulation, but simply your own psychological inability to sit still?
Wow.
What if the biggest risk is just your own deep-seated need to constantly be doing something?
That is a profoundly uncomfortable but necessary thought to take with you. Thank you for joining us on this deep dive. Keep your analytical mindset sharp, stay relentlessly disciplined, learn to embrace the boredom, and above all else, protect your capital. We'll be right here watching the order books and analyzing the structure with you until the next deep dive.